So in today's video I'm going to be giving an update on the FTSE 100. So I last reviewed this at the start of March, and I'm just going to discuss briefly what's happened over the month of March, what the current projection is going forward, and then I'm going to look into 6 stocks that I think are ideal investments to capitalise on what we potentially have happening in the FTSE right now. So going right into it. Last month at the start of March I did a video on the 15th which I put forward a chart that I produced on the 2nd of March which just detailed what I'm roughly expecting the FTSE to do, and as you can see there's this trend line here, and we've got this resistance at the top here at 7,000, and I was expecting some consolidation. So if we look into what the chart's actually showing us now, we can see we had a rally throughout March. It's quite a large increase when you actually look at, we were down at 6,470. We are now just below that 7,000 target, and like I said, there is this this strong resistance overhead. There's also this strong horizontal resistance, and we have an area of confluence. So this is where we have 2 or more factors that are basically suggesting there's a little bit of resistance ahead that's going to take some momentum, some energy to get over. So this horizontal line, if I go back in time, I can see here we had strong support where it bounced multiple times. Finally broke it down. Once support is broken, it becomes resistance, and this is where I'm expecting the FTSE to be held up over the month of May. And then as we come out of May going into June, hopefully if things are still progressing the way that they have been with the vaccine rollout and everything else in the UK, we should see a Elliott wave 5 move up. So I want to see this first wave, pull back in the second, a long and strong third, pull back in the fourth, which is traditionally a triangle, and then I want to see this break out of an all-time high. So if I go back, I can see the all-time high here in May 18. I want to see us break above that coming into July. So you can see here around the middle of June I've got us reaching that high, bouncing off it, and then I want to see it break. Obviously on the US side of things, on the S&P, if we look at this chart, it's absolutely ridiculous. If we look at that in comparison to the UK, this was the pre-pandemic level. We had a corona crash, and you can see they actually managed to achieve higher than that all-time high by August, and since then it's been on a ridiculous rally, which you can see. And this is the argument why the UK market is looking undervalued. I mean, if we go back to the UK, you can see we're nowhere near our previous all-time high. We've been suppressed, which, there's a number of factors. There was Brexit that was involved, but now that we seem to have this momentum with the vaccine rollout and Brexit is starting to fade away into history and the background, I really want to see some of this value within the UK begin to unlock. And that's why today I'm going to talk about 6 stocks that I'm currently looking at to try and take advantage of this move. If I just look at this, where we're currently at the minute and where I think we're going to end up, so if we just have a look at this, so we're currently there, and even the all-time high, that's still 14% away. How can I capitalise on that 14% move over the next 3 months? That's what I really want to look at. So the first stock I really want to look at is M&G. So M&G was previously a part of Prudential. They are an investment management company in the UK. As we can see here on Hargreaves Lansdown, they have an 8.4% dividend yield. So in terms of income, you're not really going to find many stocks that are offering higher than that. I mean, there is one there's actually 2 that I'm showing in this video that are higher, but these really are the creme de la creme. You will not find any higher dividend stocks than this. So M&G, let's look at the focus on that. So obviously very profitable. You can see that even throughout the pandemic, their profits still held up. Revenue, I'm not too focused on with M&G. Like I say, they are an investment management company. So it's really looking at that profit side. How well are those investments doing? How much are they actually earning off of those investments? If we look at the chart, we can see that M&G floated here, October 19, had a rally up, and then the corona crash. Since then we've been in this ascending triangle, and we can see clearly here this strong level of support, and we can see here a strong level of resistance, and this is the triangle that we're facing. If I look recently, the price action, so we hit that upper resistance, and now we're looking to come back down, and the area I've picked out here is this support zone. We can see resistance, broke through it, support, and I want to see this confluence here. See where we cross? I want to see it come back down to this £2 mark, and that's where I want to buy. And then again, if I look at that target, there's a 30% increase there to that previous high. So I really think that this stock in particular can capitalise on the growth within the UK. And like I say, what is really attracting me to this is the dividend aspect of it as well. I could hold on to a year on this, it could go nowhere, and I will make that 8%. You know, when you put that into perspective, if I invest 10,000 into this stock, I'll make £836 if that stock goes absolutely nowhere. But you can see the rally it's on at the minute. It was around this 120 April last year, and we're up now to 220. I'm expecting this rally to accelerate over the next couple of months. So my next stock, it's on a similar trend. So it's in that same sector. It's our VPC Specialty Lending Investments. And these are, yeah, like it says, it's a lending investments company. It's basically investing in startups, it's investing in SMEs. And again, if we look at this stock, it has great momentum over the last year or so, and we can see it's actually reached its all-time high, and it is pulled back a little bit. Again, there's a 9.3% dividend yield on this. Highly profitable. I mean, we look at those margins; they're huge. And if we look in terms of entry, so we've just broken above this resistance. It acted as support, and we've just started to push off it. And what we can see is the Corona crash. We have this line of support, which it's been adhering to quite strongly. We can see touch points here, and it's looking like to rally further. And this is what I really want to pick on now. For me, I would buy in here at 85p, and I would try and follow this rally upwards. Like I say, we've already achieved above pre-pandemic levels. I want to really be attacking this IPO level here, this 101. That's where I want to see, which is again looking at 25% gain. Okay, so my next stock is TCAP. TICAP Group. Again, dividend yield 2.9%, which is still above the average on the FTSE. It's a provider of market infrastructure, which basically means it's a broker in effect, and it mainly operates on like the energy markets. It also does data analysis. Again, the idea is with the markets over the next couple of months, there's going to be higher activity as retail starts to open up, travel starts to open up. There's going to be more fuel consumed, there's going to be more movement in the markets, not just the oil market, not just the FTSE, not just the US, but every market, every tradable market around the world is going to see an influx of activity. And what I really like about TCAP is if we can kind of look at these waves that's forming. If we look on the price action, I can see here an ascending sort of megaphone pattern, and what I've just picked out here is resistance levels. So you can see we hit that resistance, we've got clear support here that we've touched once. I'm looking for this to come back down, hit that support again, and then what I really want to see it attack is this level here. We can see we had a gap down. I've done the fib retracement here, and what we can see is that the 0.786 level lines up with that. So what I really want to do is buy in here at 230, and I want to look to take some profit potentially around this level, hit the upper band here, look for a bounce off which would be in line with this wave, and then buy back in, and basically just follow that until we basically break this trend. Okay, my next stop, again, a lot of these I'm not picking companies that are high risk. I'm looking at companies that are a fairly safe long-term investment. There's nothing high tech about them. They're pretty much funds. They're basically managing the money for you. This next one, Standard Life Property Income. If I look at this, the thing that's drawn me to this is, one, it's property, which has taken a big hit throughout the pandemic. Standard Life in particular focus on offices, retail, industrial. So what I want to see with this is obviously everyone's kind of looking at the way people are working at the minute, and that there's going to be this increase in people working from home. And what you kind of see from the workforce at the minute is this feedback that work from home doesn't work solely. There's got to be a balance. Some people prefer 1 day a week, some people prefer 2 days a week, 3 days a week, etc. But there still needs to be a physical office. And this is where I think the downtrend in properties really kind of hit its low around this September time. And people are going to start to realise that offices are still required. You still need an office space. You still need retail parks. It's still a requirement. and that's what I'm really looking for in Standard Life. We can see prior to the pandemic we were trading around the NAV level, so the net asset value. That's currently around this 82 level, and you can see at the minute we're on a 21% discount. It's been as low as 40%, and what I want to see is this basically recover back to NAV. Again, we've got a 5.2% dividend yield on this. So if I go on the chart here, I can see this recovery. We've got a strong support line here. We've just crossed over this resistance. You can see we kept hitting it. We've broken above it. We've done a hammer candle. And what I want to see now is a real thrust higher to this 73 mark. And that's where I'd be looking at taking some profits and looking at buying back in on a pullback. So this is almost just broken out. The volume's not particularly massive, which is what I'd like to see next, is volume here start to pick up. You know, ideally I want to see this big spike of people jumping in and pushing that price up. So that's Standard Life. My next share, so this is the fifth share that I'm looking at, is PayPoint. So PayPoint provides specialist consumer payment, and again, the lockdown's easing, you're going to see consumer spend increase, which means naturally this company should be making higher revenues. You can see back here, when we had the fall off in consumer spend and the lockdowns come in place, we had a sharp pullback, sharp downtrend correction. And you can see with PayPoint, we've consolidated, but we've not had that recovery like in other industries so far. We are yielding 6.5% on PayPoint. They have been paying dividends throughout the pandemic. They've kept that, which shows real confidence. We can see here their results on the 31st of March were really good. Since then, they've been reporting strong results. They had a disposal where they achieved more than net asset value. And what I really want to look at this is where we could enter on this chart. You can see there's a lot of resistance, there's a lot of support. It looks fairly messy, and it looks like there's a lot of overhead pressure. But as soon as we get above some of these levels, we could really see the price action accelerate. And that's what I'm looking at here. We can see volume starting to build up. We can see we're really low here. It's started to accumulate, starting to tick up. I mean, we did drop here. This is when we paid that dividend and we had a sell-off. And what we can see now is the momentum, the trend starting to shift upwards again. And what I want to see here is a real strong bounce off of this and test this 720 level. What I'd be looking for is test 720, pull back to this support, and then try and work our way higher. I mean, on this stock, it's just amazing looking back. You know, pre-pandemic, we were down £10, £11 a share. The company's not really changed too much in terms of profitability throughout the pandemic. It's managed to hold that, which means I think this is a real good opportunity to tap into some value within the UK and basically play a trade here that could see us recover back to this £11 as well as a 6.5% dividend. Okay, my final stock that I'm going to report on is Diversified Gas and Oil. So I've been in this company since, I think it was around here actually, around about this August, September time. So this company yields 10%, and this is one of my favourite oil and gas plays. And the reason that is because of their strategy. So the CEO founded the company, and his strategy was to basically buy up oil fields in the US that are inefficient, that aren't commercially viable. So he was buying up these oil fields when the oil price was naturally low. It was around the $30, $40 mark. He was buying them up, he was investing in the fields, he was increasing the production, increasing the efficiency, and then obviously as the commodity prices recovered, that's where he was making the profits. And what he does is he hedges all of his oil. So he completely locks in that price for the year, so you know exactly what the dividend is you should earn as long as you produce that amount, because he's already locked the price in, so that price is fixed. And what he did when the rates, so I don't know if you remember oil, the price of oil, we had a large sell-off where the price in the US actually went negative. You can see on the UK it went down to £16 a barrel, and since then we've rallied. So at this point here, he did something that not many companies would do. He went to a bank, he took out a $1.6 billion loan, and he started buying as many oil fields as he possibly could. And the reason he's done that is in line with his strategy when he founded the company, is that as soon as the prices drop, that's it, he goes out shopping, and he's gone out and he's bought some assets in Texas. And what he's doing there, it's not taking much to get them up to a commercial state, because the prices have naturally gone back up to a point where they're above break even. But he's invested in those fields, he's invested in the productivity. And the idea is that in 2021, he's going to be basically sitting on oil fields that are producing significant amounts of profit that he's hedged in around this 60, which is what we're really looking at here. He's going to 100% hedge it. If he can get that $60 price, he knows that he's got a year's worth, or even longer than a year's worth, but he's got that profit locked in as long as he keeps producing. And that's why he can sustain the dividend yield of 10%, because he already knows in advance what he's going to be making in terms of profit as long as he hits the productivity. So this is one of my favourite oil plays, is just because it's such a simple strategy and it's such an obvious thing to do with the price of oil and how volatile it is. But there don't seem to be many companies that follow this hedging strategy where they hedge 100% and where they take the risk of going out when the price does drop and actually buying up these fields that aren't commercially viable at the time. We can see we've had a little pullback recently. If we look at the chart, we've got this kind of line here of which was resistance. It got broke out to support, and we're starting to see it act as support again. We can see here there was a clear channel, so we had this kind of pivot point here, touch points, and then again at the bottom here, touch points. We broke below it, so it's now resistance. We bounced off it here, and we're sort of in between. And what I really want to see this be is a fake out, so basically a bear trap. It's faked out, it's gone below, it's hit this strong support level, and I really want to see this start to move higher. I think it's a really good opportunity to get in on oil, not only for the short term but for the long term. This dividend of 10%, you look at that and you think, okay, it's ridiculous, but he's been paying and increasing it every single year. If we look at this going back, how much he's actually increased it, it's ridiculous, and it's because he's hedging it. Even when the oil prices were low, he's still increasing the dividend yield, which is showing that his strategy is working. So that's it in terms of my review of the FTSE and what I'd be looking at to capitalise on the opportunity we have ahead.